Japan, you've seen it. The US is printing money. China's economy is slowing. But Japan, quiet, calm, sushi-sipping Japan, might be the ticking financial time bomb no one's watching. Let's break it down. In the late 1980s, Japan was the darling of global capitalism. Real estate prices in Tokyo soared so high that the land under the Imperial Palace was once said to be worth more than all of California. But by the early 1990s, that bubble burst hard. For 30-plus years, Japan's growth has been flatline. GDP, stagnant, inflation, non-existent, interest rates, near zero since your parents were in college. So what did Japan do? It went full Band-Aid mode. They printed money. They bought their own debt. They bailed out everything. Result? A weird Frankenstein economy that looks fine, but is propped up by duct tape, debt, and denial. The Bank of Japan doesn't just influence the economy, it owns the economy. Owns over 50% of all Japanese government bonds. Owns massive chunks of Japanese ETFs, yes, stocks. Controls interest rates like a god playing SimCity. It's not capitalism, it's central bank cosplay. If the BOJ ever tries to raise interest rates or unwind its balance sheet, kaboom! Markets crash, bond yields spike, global investors panic, because when the BOJ sneezes, the entire carry trade catches the flu. The Japanese yen used to be a global safe haven. Now, it's in freefall. Hit 34-year lows against the dollar, down 40% in a decade. Japan is importing inflation like it's sushi from Costco. Still think Japan is boring? When currency goes haywire in a G7 nation, it's not just Forex nerds who panic. It's the $20 trillion debt market that gets nervous. Japan is the world's quiet rich uncle. It holds more U.S. Treasury debt than China, massive investments across Europe, Asia, and emerging markets. The world's biggest pension fund, GPIF, with $1.4 trillion in assets. But here's the kicker. Japan is selling. Why? Because the yen is weak. Japan's population is shrinking and aging rapidly. By 2030, over a third of its citizens will be over 65. This means fewer workers, lower tax revenues, and ballooning pension and healthcare obligations, all of which make debt sustainability even harder. As interest rates rise, Japan is at risk of entering a debt trap, where new borrowing is increasingly used just to pay interest on existing debt. Even a modest rise in yields could lead to exponential increases in debt servicing costs. The yen is weak, so Japanese investors are bringing money home. And when they pull back from global markets, bond yields spike globally. Emerging markets lose capital. Liquidity dries up. That's how a local problem becomes a global earthquake. Post-Fukushima, Japan shut down most of its nuclear power plants. It became heavily reliant on energy imports. And what's energy priced in? Dollars. With a collapsing yen, Japan is now importing inflation through expensive oil and LNG, bleeding foreign reserves to pay for energy. At the mercy of dollar-based pricing, in a geopolitical landscape where the U.S. restricts exports, the Middle East is in turmoil. Russia's energy is sanctioned. Japan's energy insecurity magnifies its financial fragility. Japan is a technological giant. Robotics, semiconductors, consumer electronics,